Welcome to Zaf Financial. My name is Gilbert. Today we are going to talk about how to read and understand an IUL illustration. Now, being able to understand your IUL illustration will help you to avoid poorly designed policies and also steer clear of fear tactics that some agents use to push other products. So what is an IUL illustration? It's a document your agent gives you to help you understand your policy. But it can come across as confusing and a little bit overwhelming, especially if it's your first time. We are talking about a 40+ page document, and also every career illustration is organized differently. All the numbers you see in an illustration is just a projection based on some assumptions, such as interest rate, policy charges, how much you'll be funding the policy each year, how long you will even be funding this policy. That's why none of the numbers on an illustration is set in stone. It's just one of the possibilities based on a specific set of assumptions. Now, when we break down an IUL illustration, any IUL illustration, there are about 5 main sections. Now, let me walk you through each of these sections using an actual illustration. This is a properly designed IUL policy for a 35-year-old male who wants to contribute $20,000 a year for 25 years. I'm using Allianz IUL products here in this example, but everything you are going to learn still applies to any other IUL product. The first section is the policy overview or the policy summary page, and this is how it looks like. It gives you basic information such as the name of the insured, the age, health rating, initial death benefit, and the premium you plan to pay into the policy. It also shows us information about some of the riders that have been selected for this policy. In this example, we're seeing the S&P 500 futures being used. We're allocating 100% to this index. We're going to look at the index in a bit. But one thing to note from here is that the initial death benefit is $390,000. We are allocating $100,000 to the base insurance and $290,000 as blended term insurance. Now, if you have been following this channel, you've heard me mention this a lot of time. That is the secret to IUL design, because the commission paid will be only based on the base insurance, which is $100,000 in this case. There is no commission paid on the blended term insurance, the $290,000. So this helps to reduce the expenses in this product. See, we do not know how the market index is going to perform. And so we want to reduce these expenses as much as possible to give our policy the best possible chance to do well, even in years that there is no growth. When you reduce the expenses, you are giving yourself the best shot to have money available to grow in the good years. And that's why we do this blended term insurance. Unfortunately, most agents don't want to do it because it reduces the commission drastically. But hey, let's do the right thing, okay? So that is what you have in the policy overview here. One other thing I want to mention, you see the riders that we have in this policy: chronic illness rider, terminal illness rider. All these riders are free. We also have the loan protection rider, also called overloan protection rider. And what this rider does is that it prevents your policy from lapsing because of an outstanding policy loan, even if the cash value isn't enough to cover policy charges. And there is no charge for this rider until it is exercised. So we always want to have it here just in case something goes wrong in the future. We also have the supplemental term insurance rider here, which allows us to blend in the $290,000 into this product, which helps reduce the expenses drastically. I've covered this in a number of videos. I'm going to link some of them in the description below. So if you are not sure of why I'm talking about blended term insurance, I highly encourage you to take a look at all this. All right, so let's go to the next section, which is a very popular one, the cash value projection. Every IUL product will have at least 2 sets of projection, the guaranteed scenarios and the non-guaranteed scenario. Now, the guaranteed scenario shows the worst possible case. It assumes little to no growth and maximum policy charges. So in this product, it assumes a 0.1% growth every year. Sometimes you see agents and other financial professionals who try to scare people by telling them only look at the guaranteed numbers. The question you need to ask yourself is, what is the probability that the market will return almost zero every single year? In fact, if this happens, then it means we have a bigger problem in the economy overall. And it's not just IUL. 401k and other investment vehicle will also suffer badly. Because of this, I usually don't focus on guaranteed numbers. But this is something you should be aware of. Let's take a look at the non-guaranteed scenarios. So this is the non-guaranteed scenario. You see, we have alternate scenario and the current scenario. They're almost the same. The only difference is alternate scenario assumes 5% growth every year, and the current scenario is assuming 6% growth every year. So you see, we are paying $20,000 a year to the policy for 25 years. And then after that, no more funding the policy. The current value shows the amount of money you have in the policy, the actual money in the policy, also called accumulation value in other products, but that is the money in the policy. And then here in this product, the cash value is how much money you can have access to. So even though we have $18,000 available, we can only have access to $15,000 here. The difference between these two numbers is what we call a surrender charge. For each product, the surrender charge can last between 10 to 15 years. In this product, it's 12 years. So you can see at the start of year 13, these two numbers become the same. If the design is very good, then the difference between these two is not that big. When you see a huge difference or even zero cash value here, you know the design is not good. But here you can see that by year 13, these two numbers become the same. And from that point forward on, they are always going to be the same. That's the difference between these two columns, the current value, accumulation value, and the cash value. The death benefit here, it's going to be the initial death benefit, $390,000 plus the current value or the accumulation value. So when we add the initial death benefit and the current value, you can see that you get the death benefit. That means that the death benefit is already including your money in the policy. So you have $100,000 in the policy, $110,000 in the policy year 5, $390,000. That means a total of $500,000 in death benefit. Sometimes people say the insurance company only pay the death benefit and they keep the accumulation value or the cash value, but it's already baked into the death benefit. It's already included in it. So don't let this confuse you. The death benefit is your cash value or the current value plus the initial death benefit. So I hope that makes sense. So this is how the non-guaranteed scenario looks like. Now, I want to point out something. Don't expect your policy to follow the exact projection shown here, as it's just one of the many possible outcomes. No one can predict how the market index will perform. In fact, you might change your mind. You might switch some of the indexes. Nobody can predict all this. And so we cannot predict how the index is going to perform. That's why it's a good idea to use about 5 to 6% in the projection. That sets a realistic expectation. Let's go to the next section, which is index crediting. This is how the index crediting looks like. It will have a list of available market index that you can choose from. So in this product, there are a lot of options available. We have those that are based on participation rate. We have those that are also based on caps. Now, if caps, participation rate, if these things are new to you, I've covered them in separate videos. I'm going to put the link in the description below. But let's go over it briefly, quickly. All right, let's do it. So a cap represents the maximum interest credit you can get. So for instance, S&P 500 index annual point to point cap is 12.5%. It means that whatever the market index returns, you are going to get that up to 12.5%. Anything above it, let's say the market returns 15%, you don't get 15%. You're only going to get 12.5. 12.5 is the cap, is the max you would ever get in a yearly cycle. So this is annual. Now let's not confuse it with a monthly, because this might seem low. Who would choose this? Well, this is setting the cap for each month at 3.8%. So every month is calculated differently, right? So that's what a monthly index represents. The trigger method just says if the market is positive, regardless of the number, you get 8.25%. So even if it returns 1%, 0.5%, 3%, 20%, you are going to get 8.25%. I hope that makes sense. And then we have the fixed interest, 5.4% currently. All these numbers can change. It's not set in stone. But currently, this is 5.4%, which is really high. So if you want to get some sort of growth in your policy every year, you want at least some growth, then you can allocate some of that to the fixed interest. Now, when we come to the participation rate, it just determines what percent of the market return you get to enjoy or participate in. So for instance, this one has a 75% participation rate. It means whatever the index returns, you will only get 75% of that. So whatever it returns times 75% of that. That's how participation rates work. Now, I don't want to confuse you. Remember, this group has a 40% multiplier bonus. So you are going to get 40% on top of whatever it comes to after we factor in this participation rate. But this group will cost you a 1% asset charge, which basically is 1% of the money you have in the policy, of your account value. So for a 1% charge, you are going to get a 40% multiplier here. They are almost similar, but the difference here is this one gives you a 15% multiplier, but there's no charge. So if you want to gamble a little bit, then you pay 1% for a 40%. But bear in mind that if the index returns 0, you will still pay the 1% asset charge. Very, very important. But this one gives you a 15% multiplier, but no extra charge for that. This group will, instead of giving you the 15% multiplier of whatever the index return, it guarantees a 1%. So regardless of whatever happens in the market, you will get a 1% guaranteed bonus. So that's also quite an interesting option. And that's where you will have to decide how you want to allocate your money. The last group, no bonus and no charge. And basically these are regular S&P index, standard index that we already talked about. The question then becomes, what should you choose? Which of these should you choose? Nobody can tell you how the index you are going to choose will perform. And so usually the first step is looking at the historical average. Now this policy gives you all the historical performance of any index you choose, so you can see how it's performing every year. These are just the summary of the averages over the year. So 10 years period, 20-year period, these are the averages. Some of the index have not been available for 20-25 years, so you're seeing NA, that's what it means. But usually the first step is looking at averages and sort of making a guess. Now, we cannot really tell how that is going to perform, but that's how we go about selecting these ones. And also, you can allocate some of your money in one index and the other in another index. So for instance, you could say, okay, S&P 500 index, it has volatility, so let me put 50% here and then put the other 50% in a volatility controlled index, something like maybe a PIMCO or something else, right? So you have the choice. You will not know every single detail, but once you've had this policy for a few years, you can kind of have a sense of how these policies index are performing, and you can change them when you want to. Now, if you want to guarantee some growth every year, then obviously you can allocate some percent to the fixed interest, which is going to give you some money, like I mentioned, 5.4 currently. And again, let me mention all these numbers can change, but these are what we have currently. If you are finding value out of this video, please support this channel by subscribing. Thank you so much. The next important section of an IUL you need to pay attention to is the expense page. This page shows you all the fees in the product. Now, if you don't see an expense page in an illustration, you need to ask your agent to include it. I don't understand why some agents leave this critical information out. I mean, I would love to see an expense page when I'm buying an IUL policy, so I always include it. I have a separate video on IUL expenses. I'll put the link in the description below. But let's run through these quickly. So we have the age column and then amount of money we are paying to the policy each year, $20,000. We have the premium charge. In this product, it's 9% the first year and then 5% every other year. Now, this is going to vary from company to company. So this is something you have to be aware of. Once we stop funding the policy, there's no premium charge. It's based on any money you put into the policy. So let's say in a year, you are not able to pay $20,000 into the year. You put $10,000 into the policy. It's just going to be half of that year. So it correlates directly to how much money you are paying to the policy. The next is the policy fee. It's a fixed fee, $90 a year for the life of the policy. It covers paperwork, insurance company has to mail you something, anything related to documentation or all that sort of stuff. That is what the policy fee covers. We have the per unit charge here. It covers agent's commission as well as any expenses the insurance company incurred to put the policy in force. Usually it's going to be recouped between 10 to 15 years. In this product, it's recouped for 15 years. Now, if your policy is designed properly, this number is going to be quite low, like we see in this product. I've covered these scenarios in different videos. I'm going to link it in the description below. We always love transparency. I want you to see what is happening behind the scene. That's why I'm always not happy when agents leave this critical page out. All right. The next is the cost of insurance. Cost of insurance in this product covers the base insurance. Remember, 100,000 base, 290,000 term insurance. That 100,000 base, the cost is what goes in this product here, the base insurance. And then the rider charges here, it's what the blended term insurance costs. We did not add any other rider that include a fee. All the other riders had no fee. The term insurance rider had a fee, and this is the cost of the 290,000 term insurance. This is the asset charge. Remember the 1% fee we talked about earlier? If we are paying that 1% fee, is going to be in this column. Now, these are all the fees we have in this product. Other products have other fees like the accumulation value. And so you want to take a look at these things and understand what the fees are like before you get into them. The next page we want to pay attention to is the loans and withdrawal page. This page tells you what type of loans are available and how much it's going to cost you to borrow, as well as how index crediting is handled when you take out a loan. In this product, we have index loan, we have fixed loan. Index loan allows you to borrow at 5%. It's fixed throughout the life of the policy. You are going to credit it based on whatever the market returns. So the market returns 10%, you have a 5% charge. So you have a net of 5%. But if you get a 0% return from the market, then it's going to cost you 5%. That is how index loans work. The next is the fixed loan. Year 1 to 10 is going to cost you 2.91% upfront, but they are going to credit you 2%. So sort of a 1% cost here, right? But from year 11 onwards, the cost is 1.96 upfront, and then they are going to credit you 2% at the end of the year, which basically makes it a wash. So these are the loans available in this product. Very simple, straightforward. Other products have different types of loan, variable loans, and that's why you want to know these things upfront. So we have covered the most essential information you need to know. Obviously, there are other pages you can go through your IUL illustration, but I've given you the solid foundation you need to know when you are looking at an IUL illustration. Your agent will help you as well. Now, if you have any questions about IUL, policy design, illustrations, and you want to talk with me one-on-one, I'm going to have a link. We can have a Zoom session and answer your specific question. Please support this channel. Give me a thumbs up. Subscribe to my channel and let's blow up this channel. Thank you so much. I appreciate you staying with me. I will see you in the next video. Bye.